At some point when you start taking retirement seriously, you hit this question: Roth or traditional? And it feels like it should have a simple answer. One of them must be better. Someone must know which one. And yet every time you look it up, you get some version of "it depends" and a list of factors to consider. And you close the tab knowing roughly the same amount you knew when you opened it. So let's actually answer it. The reason this question is genuinely hard, and it is genuinely hard, not just confusing, is that the right answer depends on something nobody knows with certainty: what your tax rate will be in retirement compared to what it is right now. You are making a decision today about something that will not fully play out for 10, 20, 30 years. And the tax code between now and then will change in ways nobody can predict.
That is the honest version of why this is hard. Once you understand that, the rest of the decision becomes a lot clearer. Before we get into which one is right for you, subscribe and give this a thumbs up if this is the kind of content you want more of. Now let's get into it. First, both accounts are just containers. This is the thing that clears up most of the confusion immediately. A Roth IRA and a traditional IRA are not different investments. They are different wrappers around the same investments. Inside either one, you can hold index funds, stocks, bonds, ETFs, whatever you want. The account type does not determine what you invest in. It determines when and how your money gets taxed.
Think of it like this. You have money. That money is going to get taxed at some point, either when it goes in or when it comes out. The only real question is which side of that journey you want the tax to happen on. Traditional IRA. The tax happens on the way out. You put money in now, and in many cases you get a tax deduction for it, meaning the contribution reduces your taxable income this year. Your money grows inside the account without being taxed along the way. And then when you pull it out in retirement, you pay regular income tax on whatever you withdraw. Roth IRA. The tax happens on the way in. You put in money you have already paid tax on. No deduction now, but your money grows tax-free. And when you pull it out in retirement, including all the growth, you pay zero tax. Nothing. The government already got their cut when you put it in. Same destination, retirement money. Different tax timing. That is the entire difference. Now, the 2026 numbers, because they matter and they just changed. Both accounts have the same contribution limit in 2026. $7,500 per year if you are under 50. $8,600 if you are 50 or older. The extra $1,100 is the catch-up contribution. That limit is combined across both accounts. So if you have both a Roth and a traditional IRA, you cannot put $7,500 into each. The $7,500 is the total across both. The Roth IRA has income limits. In 2026, if you are single, you can make a full Roth contribution if your modified adjusted gross income is below $153,000. Between $153,000 and $168,000, the amount you can contribute phases out. Above $168,000, you cannot contribute to a Roth directly at all.
If you're married filing jointly, the full contribution threshold is $242,000.
The phase-out runs from $242,000 to $252,000. Above $252,000, no direct Roth contribution. The traditional IRA has no income limits for contributing. Anyone with earned income can put money into a traditional IRA. But the tax deduction, the thing that makes traditional IRAs attractive, does have income limits if you are also covered by a retirement plan at work, like a 401k. If you are single and covered by a workplace plan in 2026, the deduction phases out between $81,000 and $91,000. Above $91,000, your traditional IRA contribution is not deductible if you have a 401k.
If you're married filing jointly and the contributing spouse is covered by a workplace plan, the deduction phases out between $129,000 and $149,000. This matters more than most people realize. A traditional IRA contribution that is not deductible is usually the worst of both worlds. You pay tax on the money going in, just like a Roth, but you also pay tax on the growth when it comes out. If your traditional IRA contribution is not deductible because your income is too high, you should almost always be putting that money somewhere else. Now, the decision framework. 3 questions that get most people to the right answer. Question 1.
Do you expect to be in a higher tax bracket in retirement or a lower one? If you think your tax rate will be higher in retirement than it is today, Roth wins. You pay the lower rate now on the way in and avoid the higher rate later on the way out. If you think your tax rate will be lower in retirement than it is today, Traditional wins. You get the deduction now at your higher rate and pay at the lower rate later. If you genuinely have no idea, which is honest for most people, there are some useful heuristics. Early in a career, income tends to be lower than it will be at the peak. If you are in your 20s or early 30s, your current tax rate is probably one of the lowest it will be in your life. That generally points toward Roth. Pay the low rate now, lock in tax-free growth for the next 3 or 4 decades. If you are at or near your peak earning years, late career, high income, the highest bracket you are likely to be in, the deduction from a traditional IRA is worth the most right now. Taking it now and paying taxes later when income is lower in retirement can make genuine financial sense. Question 2. Do you actually need the tax break today? This is where people trip up. The traditional IRA deduction sounds very attractive. Who does not want to reduce their taxable income right now? But the deduction only helps you if you actually use the money you save on taxes productively. Here is what that means in practice. If you put $7,500 into a traditional IRA and you are in the 22% tax bracket, that deduction saves you roughly $1,650 in taxes this year. That sounds great. But if that $1,650 just flows back into your regular spending, if you do not invest it or use it intentionally, then you are not actually ahead. You are just moving money around and deferring a tax bill you will still have to pay later on a larger amount. If you put $7,500 into a Roth IRA, you do not get that $1,650 back this year. But every dollar of growth on that money for the next 30 or 40 years is permanently tax-free. No taxes on dividends along the way, no taxes on capital gains, no taxes on the withdrawal. Ever. The question is not which account has the better tax treatment in isolation. The question is what you will actually do with the difference. Question 3. Do you care about required minimum distributions? Traditional IRAs require you to start withdrawing money at age 73, whether you want to or not. These are called required minimum distributions, or RMDs. The IRS does not let you leave money in a traditional IRA indefinitely because they want to collect the tax that has been deferred. The RMD amount is calculated based on your account balance and life expectancy, and it goes up over time. Roth IRAs have no RMDs, ever. The money can sit there growing tax-free for your entire life if you do not need it. You can pass it to heirs. You can use it strategically in high or low income years in retirement without being forced to take distributions that push you into a higher bracket. For most people under 50, the RMD question feels distant and irrelevant. But for anyone thinking about legacy, leaving money to children or grandchildren, or anyone who expects to have significant other income in retirement and does not want forced taxable withdrawals on top of it, the Roth advantage here is real and meaningful. Now let's talk about specific situations, because the framework is useful, but the situations are where it becomes clear. The young person, early 20s to mid-30s, early career income, probably in the 12% or 22% tax bracket. Almost always Roth. The math is straightforward. Your tax rate right now is likely one of the lowest it will ever be. Paying tax now at 12% or 22% and locking in 30 to 40 years of tax-free compound growth is genuinely hard to beat. The specific power of a Roth at this stage is the time horizon. $7,500 per year, starting at 25, at a 7% average return, reaches approximately $1.8 million by 65. All of it tax-free on withdrawal. The tax you paid going in was on the $7,500 per year, not on the $1.8 million coming out. That difference is the entire argument for Roth when you were young. The mid-career person, late 30s to mid-40s, income growing, possibly covered by a 401k at work, this is where it gets more nuanced. If the traditional IRA deduction is available, If income is below the phase-out threshold and workplace plan coverage does not eliminate the deduction, there is a real case for traditional, especially if you are disciplined enough to invest the tax savings rather than spend them. But if the deduction is not available because income is above the threshold, back to Roth. A non-deductible traditional IRA for most people in this situation is the wrong move. The high earner, income above the Roth contribution limits, above $168,000 single or $252,000 married, you cannot put money into a Roth IRA directly. This is where the backdoor Roth becomes relevant. The backdoor Roth is not a loophole or a gray area. It is an explicitly legal strategy that the IRS has acknowledged. You contribute to a traditional IRA, which has no income limits for contributing, just for deducting, and then you convert that traditional IRA to a Roth IRA. You pay tax on any growth between the contribution and the conversion. If you do the conversion quickly, there is typically very little to tax. And the money then sits in a Roth with all the tax-free growth benefits from that point forward. The backdoor Roth has some complexity, particularly if you have other pre-tax traditional IRA money already sitting somewhere, which triggers something called the pro-rata rule. And it is worth getting specific advice for your situation before doing it. But for high earners who want Roth money, it is the standard path.
Can you contribute to both a Roth and a traditional IRA in the same year?
Yes, with one important constraint. The $7,500 limit is the combined total. You can split it however you want, $4,000 Roth and $3,500 traditional, or any other combination. But the total across both cannot exceed $7,500 if you are under 50, or $8,600 if you are 50 or older. Some people do this intentionally, contributing to both as a hedge against future tax rate uncertainty. If you genuinely do not know whether your future tax rate will be higher or lower, splitting contributions between both account types diversifies your tax exposure in retirement. This is a reasonable approach, even if it is not the mathematically optimal one under any specific assumption.
The honest answer that cuts through all of this is that for most people in their 20s and 30s earning below the income limits, which covers the vast majority of viewers, the Roth IRA is the right starting point. Low current tax rate, long time horizon, tax-free growth for decades, no RMDs, flexibility on withdrawals of contributions if you ever need them. There is one more thing worth saying about the Roth that almost nobody mentions clearly. You can withdraw your Roth IRA contributions, not the growth, just what you put in, at any time, at any age, for any reason, without taxes and without penalties. The growth needs to stay in until you are 59 and a half to come out tax-free. But the contributions themselves are always accessible. This makes the Roth IRA a more flexible vehicle than most people realize, somewhere between a locked retirement account and a savings account in terms of accessibility.
The traditional IRA does not have this. Withdrawals before age 59 and a half are subject to both income tax and a 10% penalty with very limited exceptions. The bottom line: if you are young and your current tax rate is one of the lower ones you will have in your life, Roth. If you are in your peak earning years and the traditional IRA deduction is actually available to you, traditional deserves serious consideration. If your income is above the Roth limit, backdoor Roth is the path if you want Roth money.
If you are genuinely uncertain, split the contribution. Both. The flexibility is worth more than the optimization. And if you have been going back and forth on this for 6 months without opening anything, open a Roth IRA today and put whatever you have available into a broad index fund. The best retirement account is the one you actually open. The cost of a theoretically suboptimal account that you actually fund is almost always lower than the cost of not contributing at all while you try to figure out the perfect answer. The account is the container. The contributions are the point.